Hi traders, yes, welcome back to Awesome Forex TZ and welcome back to Advanced ELLIOT Wave. It has been a while since I uploaded the last content on Advanced ELLIOT Wave. It's not about a month, it is more than a month since I uploaded the last content on Advanced ELLIOT Wave. Therefore nothing's bad, as I was still planning for continuations of the sessions, actually as normal as I was doing usually every weekend or sometimes in the middle of the week, but certain things were not okay. That's why it has been in a while. I have been silent, not uploading those contents on Advanced ELLIOT Wave. But today I'm carrying on with the concept on Advanced ELLIOT Wave, and mainly this will be the fifth part. Actually, the last one was the fourth part, and the fourth part was mainly about throw over and throw under. So I remember that thing was throw over and throw under. So today we are going to the fifth part, and it's the fifth part out of 12 sessions that have been planned to complete the whole series of sessions on Advanced ELLIOT Wave. So today we are going straight to what we call the fifth part of Advanced ELLIOT Wave. And now our today's concept, we are on the fifth part. Mainly we're in the fifth part of Advanced ELLIOT Wave out of those 12 sessions, and our today's concept is ELLIOT Wave is not a trading strategy. Now this is what we are going to cover on the fifth part of Advanced ELLIOT Wave. ELLIOT Wave is not a trading strategy. Yeah, I'm sure there are many ELLIOT Wave practitioners out there who are actually trading using the wave principle, but they have not yet recognized that the wave principle or ELLIOT Wave is not a trading strategy. So now today I'm going to make this brief, and I will show you how you may work with the wave principle without taking the wave principle by itself as a strategy. So now, saying that ELLIOT Wave is not a trading strategy, it's not just my say. Actually, for those who have joined ELLIOT Wave International, I'm sure they have already met with Jeffrey Kennedy, one of the major ELLIOT Wave practitioner, and actually he give out trainings and other things through ELLIOT Wave International. So one of his saying was, why do people have difficulty trading the wave principle? He did one video explaining this concept. Why do people have difficulty trading the wave principle? So now most of people, they are interested with the wave principle, how it works, the theory of the principle, how it works. But when they come to apply it in a real market, actually the principle is like not real working as how the theory is. So he tried to give an answer here. This is according to ELLIOT Wave principle, according to the book of ELLIOT Wave principle. Actually, the book itself tells us that the primary value of the wave principle is that it provides a context for market analysis. The primary value of the wave principle is that it provides the context for market analysis. And now, in addition to that, you'll find that the wave principle as it stands is not a trading methodology. So we can call it as not a trading methodology or not a trading strategy. But basically it provides us with a context for market analysis. So now here is where my fifth content for Advanced ELLIOT Wave comes from. So today we are going to look on now, if ELLIOT Wave is not a trading strategy, so how may you work with it? Also, the same thing, actually, I've been sharing those things like quotes. They are like quotes on Instagram. So for those who actually visit this Instagram page, which is Awesome Forex TZ, usually I think they have already met with the same concept. This one, wave principle as it stands is not a trading methodology, but it provides a context for the market analysis. Actually, I've already shared this. So now today I'm going to make this brief. Usually there are many ideas that are shared on Instagram. They are like quotes, but actually these are the contents from Elliott Wave books. So for those who have covered the concepts on Elliott Wave, I'm sure they understand everything that are usually being shared through Instagram quotes. They are like Instagram quotes. So now, if Elliott Wave is not a trading strategy, now how are we going to work with it in the market? How are we going to work with it in the market? Now, taking you back to, I think it was 2019, taking you back to 2019, there was one concept, there was one content that was presented, was what you call an arrow trading strategy, or the PSC strategy. An arrow strategy or the PSC strategy. Now, this one tried to explain on how you may apply the wave principle as a strategy in the market. It was not just directly taking the wave principle as a strategy, but you have to put some rules in order to trade with the wave principle as a strategy. So now, what are the rules that you can put, and why the wave principle by itself without adding some rules is not a strategy? Because we have certain basics for a strategy. We have certain basics for a strategy. In order for anything or any conditions that you apply in the market to be a strategy, they must have certain criteria. So we call them as the basics for a trading strategy. Basics for a trading strategy. Usually, any trading strategy should be provide you with various basic things, but the main three things that I can concentrate with them is it should provide you with position sizing, also should provide you with an entry, and also should provide you with an exit point. So when you cover the concept of Elliott Wave, actually there's no any concept about position sizing, there's no concept about entry and exit. Actually, there are no direct things like that. So what you're supposed to do is to add your additional rules on the wave principle in order to make it have those criteria for a strategy, to give you position sizing. And mainly in position sizing, it is just an idea of money management. The way you determine maybe amount of money that you can risk in each trade actually is based on position sizing, but in a general picture we can call it as money management. But position sizing is just a very straight concept. So now you must have those things incorporated within a wave principle in order for the wave principle to work as a strategy. But if you take the concept directly without adding certain rules or certain conditions, actually the wave principle as it stands by itself is not a trading strategy, but it will provide you with just one thing. May provide you with tactics on determining the direction of the market. You will just determine the direction of the market, but you will not have those rules for an entry, also rules for exit. So now, how may you develop those things and trade with the wave principle as a strategy? So how may you deal with those things and develop the principles to work with the Elliott Wave as a strategy? So that is an idea that we are going to cover today, and that will be the major content of our today's presentation. So now let's go straight to the whiteboard. I want to take you straight to the whiteboard in order to have an idea about the wave principle. To have an idea about the wave principle on how you can incorporate those rules in order for the wave principle to work as a strategy. So now let's go. The internet is somehow slow. That's why things are like not working or responding on time. They are not responding on time. But nothing's bad. So let's go to our today's content. Let's go to our today's content. Now, Elliott wave is not a trading strategy. So now let's go to see how you can work with the wave principle as a trading strategy. Now, in order to work with the wave principle as the strategy, you may just sit down and create your own rules and then trade with the wave principle profitably as the strategy. But if you cannot sit down and do that task of creating those rules and principles that will guide you on how to enter and exit the market through the wave principle, now we have this. I have already shown you the video about the arrow. We have this, to call it the arrow strategy. We have this, to call it the arrow strategy. The arrow strategy. Now the arrow strategy in a simple way is known as PSC. In a simple way is known as PSC. Now this is the only way you can apply the wave principle in the market as a strategy. This is the only way where you can apply the wave principle in the market as a strategy, and mainly it was developed on 2018. Now this was developed on 2018 for the very first time, and no one have already talked about this. No one have already presented this idea on the internet about the arrow strategy or about the PSC strategy. So basically for the very first time, it was on 2018 where I developed this principle, the arrow strategy. I developed this strategy, the arrow strategy, as the means to apply the wave principle in the market. So now, why we call it as an arrow strategy, and what stands for this PSC? Now, what PSC stands for? Now, for the very first time, I think when you hear the arrow strategy, you can have you can create an image about, now what's all about the arrow? What's all about the arrow? Now, mainly we have an idea about the arrow. When you want to shoot, maybe if you have an arrow, you want to shoot at your target, mainly we expect that you have to pull back an arrow. Now, you have to pull back an arrow before shooting your target. You have to pull back an arrow before shooting your target. So now here's where the term arrow strategy comes in. It comes from the idea that once you have a target and you want to shoot it with an arrow, you have to pull back an arrow, and then after that you'll be able to shoot your target. So it's where the arrow strategy comes in. And PSC, now we have this PS and then we have C. Now what does this represent? What does this represent? Mainly PSC, this stands for pullback. This stands for pullback, and then we have this, we call it a setup. We have this, we call the setup, and finally C stands for the comeback. This stands for the comeback. Now it's what we call the pullback, setup, then comeback. Pullback, setup, then comeback. Now this has got the same meaning as the arrow. Now pullback, this P stands for the pullback. Now this arrow, I said that if you want to shoot, first of all you have to pull back. You have to pull back an arrow. Then after pulling back, we have a setup. A setup, actually, when you want to hit the target, so you have to take a right position. You have to position this an arrow. You have to position an arrow in a right way in order to hit the target. So when you are positioning this arrow, you are making a setup. When you are positioning your arrow, actually you are making a setup in order to hit the target. So now, after allowing an arrow to go to the direction where the target is, now it's where we call an arrow is coming back, the came back. Now when an arrow is going to the direction of the target, now this is what we call the comeback, because at the beginning it was at this point, then you pulled it back. So now when it's going back to its original point, it's what we call the comeback. So now here is where the pullback setup and the comeback comes in. So now this is just theoretical. This is too theoretical. Now we have those informations about this, and this was the notes actually about the whole PSC strategy. Actually, these are the notes for the whole PSC strategy. So now it is an arrow strategy of the PSC. Now it's all about pullback, setup, and the comeback. Now in an introductory part, actually I'll not go beyond those things. I'll go straight to the Webu principle, because everybody have awareness with the Webu principle. So mainly I will be incorporating the Webu principle with those additional rules that will guide you to have an entry and exit. So this one just explains an introduction on how you are going to put those rules in ELLIOT Webu and to trade with the Webu principle as a strategy. So we have those information that explain everything about the PSC strategy. But now I'm going straight to the concept to see how you will develop your own rules and trade with the Webu principle. Now everybody knows the now according to ELLIOT Webu, markets usually basically PSC according to PSC strategy, you will trade a trending market. According to PSC strategy, you will trade the trending market. So we are unable to trade the ranging market according to PSC. Usually this applies on the trending market. Now a trending market can be trending upward, or it may trend downward, in anywhere around. It may be trending upward, or it may be trending downward. So in any trending market, except to the sideways movement, of the market, in any trending market that trend upward or downward, you can apply the PSC strategy. Now, how this may work? Now, in a trending market, I'll take a scenario of an uptrend. Actually, I'll take a scenario of an uptrend, and then those rules that I'll put in, they will apply even in scenario of a downtrend. So now, example, in an uptrend, a market which is trending upward, will have the first wave, then the second wave, then we'll have the third wave, the fourth wave, finally the fifth wave to the top. Now we can label those waves. Now this is the first one, then we'll have the second, and then the third wave, we'll have the fourth wave, and finally the fifth wave to the top. Now this is just a very basic concept that everyone knows, but what I want to show you here is to incorporate those rules within this basic structure of the Webu principle, to incorporate rules within the basic structure of the Webu principle. So now, if we already have this structure, we're going to see how you can put those rules, and mainly we are going to see the entry, we are going to see the exit, and then we are going to consider the money management rules. We will consider also the money management rules. So now, based on PSC strategy or the arrow strategy, you'll be able to trade the third wave. You'll make an entry on the third wave, but also you can make an entry in the fifth wave, and mainly this is in it is mainly in an impassive move. In an impassive move, you'll be able to trade confidently those three waves. Actually, you will trade, those two waves. You will trade those two waves confidently, the third wave and the fifth wave. But now, when the market has started correcting, when it is in a correction phase, mainly correction phase is an A, B, and then C to the downside. It is usually an A, B, and C to the downside. So now, when the market now is in a correction phase, you will be able to trade wave C. You will be able to trade wave C. So now, these are the basic areas where you are going to trade. So therefore, we'll put additional rules on those areas, because everybody knows the third wave, everybody knows the fifth, and everybody knows wave C. But now, how you are going to trade? So we are going to put additional rules that will guide you on how to take trades within those three positions in the wave structure. So now let's start on how you are going to take a trade in the third wave. How you are going to take trade in the third wave. Now, usually, when the market has completed the first wave to the top, usually the second wave is an ABC. It is a corrective move. It is an ABC, a corrective move. So when the market has already completed this correction, you will have various ways to identify that the correction is completed. You will have various ways on how to identify completion of the correction. So now, if you will have that and already identified that the market has already completed this correction, so what we expect is the 5 wave move to the top, which will be the third wave. The 5 wave move to the top, which will be the third wave. So the market will start with, as usual, it may be 1, then 2, 3, 4, 5, and anywhere around. So now, after having those 5 wave move to the top, let me clear this. It's not in a balance the range. Let me put it this way now. Yeah, like this. So now, let's go down there. When the market has already completed the correction at this area, it's where you will start looking for your entry. You will basically start to look for your entry right from that area. Now, this area will have a lower point there. Where it turned up. The lower point where it turned up. So now this lower point, those are the major principles that we are putting on the Weber principle. Those are the key things that we add on the Weber principle in order to use it as a strategy. So now this lower point there, here, which is marked by yellow color, now because the market has already turned and it's moving up, so this point here will mark it as invalidation. This will be an invalidation level. This will be an invalidation level. Now, why we call this as an invalidation level? Because we have already identified that correction has been completed. We have already identified that correction has already completed. So now, if correction has already completed and the market has started moving up, so we expect that if it is going to make a correction within a third wave, correction in a third wave will never exceed this level. Correction within a third wave do not supposed to exceed this level. That's why we call it as invalidation level, because when a price corrects and exceeds this level, it means the upward movement is no longer valid. The upward movement in the third wave is no longer valid. That's why we call this as invalidation level. But basically, for the first for the first wave and the second wave move, invalidation of correction mainly is marked when the price moves beyond the beginning of the first wave. Usually when the price moves beyond the beginning of the first wave, it's where the uptrend got actually cancelled out. We cancel it out if price has corrected and moved beyond the beginning. So now, for trading purposes, you can consider this turning point right there. But also, if you need to have a high degree of confirmation for validation of the upward move, you may add this level here, whereby the second wave may not correct to 100%, may not move beyond 100%. Usually it may move up to 99% of the first wave. It may correct the first wave up to 99%, but not 100 or beyond 100. So now we have already identified this invalidation level. So we are going to see, we will see how you are going to use this invalidation level. But we will have another key level. We will have another key level right at the top there. Right at the top there, we will have a second level. We will have a second key level. Now, this second key level, this is known as validation level. This is known as, or it's now, we can call it as confirmation now, basically, or principally, this is known as confirmation. This is known as confirmation level. This is known as confirmation level. Now, what is confirmation level? Confirmation level is the level where once the price has passed beyond that level, it means the movement of price in a particular direction will be already proved that it is true that the market is holding in that particular direction. So now if it is an uptrend, then we have a confirmation level right there. Once the price has moved beyond this level, we have this one, price has moved beyond. Once it has moved beyond this level, then it has retested it. It has corrected by retesting the level without breaking this level, and then it resumes upward. Now this we call it as a confirmation. It means a confirmation of the upward movement. This will be the confirmation of the upward movement, or it may be downward. It depends on a particular trend. So if it is an uptrend, so actually this will confirm that an uptrend is in action. This will confirm that an uptrend is in action. That's why we call it as confirmation level. So now we have identified those key levels. We have identified those key levels, but we will have a zone now. We will have a zone now. So combining confirmation level and invalidation level, this area, the area between confirmation level, the area between confirmation level and invalidation level, this area is known as valid zone. This is known as valid, this is known as valid zone, a valid zone. Now, why this is known as valid zone? It is valid zone because once you have identified your invalidation level, once you have identified invalidation level, and then you have identified a confirmation level, when the price is moving within those two levels, when the price, now you had an uptrend started being developed, so now you are looking for continuation of an uptrend. So once price is playing within this level, it is playing within validation and invalidation. It don't break the invalidation. Now that price movement will be still valid for the uptrend, will still be valid for the uptrend. But if it moves beyond invalidation, now the uptrend will be invalid. But if it will be playing in any way within those two levels, this level is still a valid level. This level is still a valid level. So now after having that key level, the valid zone, confirmation level, invalidation level, and having a valid zone, now you can put in your trading rules in order to trade the third wave. Now we need to understand on how you can trade the third wave. So now you can put on your rules on how you can enter in a trade to trade the third wave. Now after having the invalidation level, now the price will be already started moving up. You will have two areas where you can take trades. You will have two areas or two major areas to take trade. Now your first area will be around the invalidation level. After you have recognized that price has completed the correction and it has started moving up, you can find an entry near the invalidation level. You can put your trade right near the invalidation level. Now here is the first part where you can make an entry. Now if you have an entry at this area, where will you put your stop loss? Now your stop loss should be it is just a few cents. You will put it few cents below the invalidation. Now if your consideration about invalidation level, if you will consider this as invalidation level, now your stop loss should be right below this area. But if you take this lower level as invalidation, now your stop loss should be few cents. You must put it few cents. Now one mistake that most traders do is when they have identified those levels in the market, maybe a zone, they have identified a zone, actually you find that they put their stop losses actually exactly within a level. They put their stop losses exactly within a level. But mainly movement of prices like that, when the price is moving up, it may come and retest this level. So if you put your stop loss within this range, actually your stop loss will be taken out. So now you have to put it a little bit lower. You have to put a little bit lower because sometimes there is manipulation of the market, so the market may move little bit below the previous move here. So if your stop loss is too tight, also can be hit. So you take some cents below it, so you can put it right below the invalidation level. Now after having that, let us see the second point where you can take an entry. The second point or area to take an entry is a confirmation level. The second major part to take a trade is a confirmation level, whereby within a confirmation level, what are the principles to take a trade in confirmation level? Now once the price has broken the level, this one, a confirmation level, has broken the level, then it has retested it. After retest, you will take a trade there. You will now to take a trade, you have to check for candlestick formations. In most of cases, we use candlestick formations. Actually, candlestick patterns, things like pin bars, morning star, and other things. Actually, you can check formation of those major candlestick patterns around this area, then you can enter the trade. Also, even at this level, you check for the candlestick patterns, then you take a trade. But now taking trade at the confirmation level, you have to wait for retest. Now since this is the third wave, usually third wave is very powerful, actually very powerful, or it is very emotional. So in most cases, if you use higher time frames, it is very hard to identify those retests and other things. So if the market is very emotional, you have to switch to lower time frames in order to be able to see those retests. Now those are the two key areas to take a trade, but you may have other rules that may guide you to take trades, whereby you can take a trade in any area within a validation zone. You can take a trade at any point within a validation zone. So you can add some rules to take trade at any point within a validation zone. Maybe the market was moving up, has retraced, you can take a trade in order to keep on moving up with this move. But now, if you have taken a trade at the confirmation level, where will you put your stop loss? Now your stop loss, as usual, you have to find a key level. If it retested the zone, your stop loss should be right below the zone. It should be right below the zone to protect it from being taken out if the market will be manipulated and move right below the point where it bounced at the beginning. So now we already have covered the idea on entry. We have identified the key areas where you can take your entry. Now you'll find that those things have not just incorporated in the wave principle by itself. When you cover the wave principle, it don't have those rules: entry, exit, the issues on money management, where can you put your stop loss and other things. They are not incorporated within the wave principle by itself. That's why most traders, they fail to trade with the wave principle because they take the wave principle as how it is and then apply it in the market without adding some rules that will guide them on how they can manage their money, on how they can enter the trade and how they can exit the trade. Now let's go to the idea of take profit. Where will you put your TP? Where will you put your take profit? Now, putting a take profit, now this may vary based on wave relationship. Based on wave relationships, and actually we're talking about the ratio relationships, you may predict the position at which you may put your stop loss. Now, if you are trading the third wave, usually you can use, now you are trading the third. Usually, your take profit can be projected by having a 1.618 wave relationship. This is the relationship between the first wave and the third wave. Actually, in most cases, the distance traveled by the third wave is 1.6 to the distance traveled by the first wave, and this is by the use of Fibonacci tool. You will use a Fibonacci tool, and this is what we call Fibonacci extension. This is what we call a Fibonacci extension. Now you will measure the extension of the third wave. Therefore, your projections or a point for take profit should be around the 1.618. That's how you identify your take profit. Now, this will have no relationship with where you took your trade. Maybe if you took there, you'll measure the 1.618 maybe from this point. No, your 1.618 actually it will involve the first point, the second one, and the third one down there. So you will project the whole move actually without depending on where you took your trade. That's all about the issues on take profit when you are trading the third wave. Now, trading the fifth wave actually have got similar rules as how you can trade as how you can trade the third. As how you trade the third wave, you will apply almost similar rules on the fifth wave. You have first of all to identify that correction has completed in the fourth. You have to identify correction as completed in the fourth. If correction has completed, actually you will have a level at which, now as usual, you will have a level at which the third wave topped up, and then you will have a level for the fourth wave. So now, as usual, this level below where the fourth wave has stand up, now this will be the invalidation level, and then the level at which the third wave topped up, Now this will be the confirmation, as usual, the confirmation. So you will take a trade either right at the around, now it is not exactly at that level because you never identify it before it has completed. So you may take a trade around the invalidation level, and then you can take a trade at the confirmation level. The same thing as we have done with trading the third wave. But now, where will you put your TP? Now, where to put your take profit? Now, your take profit in the fifth wave. In the fifth wave, your take profit in most cases can be around 0.618. Can be around 0.618. Being around 0.618, now this is an extension of the fifth. In most of cases can extend up to this one. Now this also will depend on whether extension is within the the third wave or in the fifth wave. So you have to incorporate other things like Elliott wave rules and guidelines in order to have an exact projection of where to put your take profit. But technically trading the fifth, now technically trading the fifth, it is very tricky. Trading the fifth, it is very tricky, and it has got a very high risk because it is more variable. The fifth wave is more variable. Now you can find that in most contexts, the fifth wave, it is actually not most, actually sometimes in the fifth wave may not move beyond the top of the third. Actually you find that it has got 1, 2, 3, 4, 5. It has completed within the top. Within the top, it has not broken beyond. So sometimes you'll find that it gets truncated. I've already presented those things on the previous presentation about the issues on truncation and other things. So it is more tricky to trade this one actually, and therefore I can say that it is too risky because it has got uncertainty, many uncertainty. So make sure that you become more protective when you are trading the fifth. You become more protective when you are trading the fifth. But you have high probability of hitting your TP if you are trading the third. Trading the third is highly suggested. Now we are through with the fifth. Now let's see wave C. We recommended that you can also trade wave C. Now, and in addition to this, you can trade wave C, and in addition to wave C, you also may trade combinations. You may also trade combinations, whereby in a combination you can have things like the WXY, or sometimes you can have a WXYXZ. You may have a WXYXZ. So now, in addition to C wave, now I will explain C wave, but in addition to this, make sure that you know that you will apply similar principles when you are trading combinations, and whereby you and mainly in combination you can trade wave Y, or you can trade wave Y and wave Z. It depends on which type of combination. Maybe it is just a double combination, or it is just a triple combinations. But now my target here is to explain on how you can trade wave C profitably. Now we have this as an A, B, then C to the downside. An A, B, C to the downside. After you have recognized that the impassive move has completed, now we expect a correction. Now correction has got an ABC. It can be in any way. It can be flat. It can be anything. So now make sure that you have an idea. You have awareness about the structure of a corrective wave. Example, if you find that the first move here has got 1, 2, 3, the first move has got 1, 2, 3, mainly we expect that this will be flat. But if you find that the first move here has got 1, 2, 3, 4, 5, actually we are sure that this corrective, the whole collective structure will be zigzag. If we have got 5 wave move in wave A, but if we have 3 wave move in wave A, now this will be flat. So now you have to be very tricky when you want to trade this correction. Now, correction, how you are going to trade it? After wave A has got completed, we will have this level. After wave A has got completed, we will have this level. Then it will be wave A will be corrected by wave B, whereby wave B can be anything else, can be zigzag, ABC to the top, can be ABC to the top. After you have identified that, wave B now is complete. After you have identified that, wave B now is complete, so you will wait for wave C now to take place. You'll be looking now, not waiting, it's just looking for wave C, and now you are going to trade it. You are looking for wave C and you are going to trade it. So now, how are you going to trade? As usual, you will have this level where wave B was completed. As usual, this will be the invalidation level. Then you will have this level, the top of wave. Now this is bottom now. The bottom or the peak of this wave A now, this will be the confirmation level as usual. So you can take your trade right at that area and then wait to hit your TP at the point where wave C is going to get completed. As usual, you can put a stop loss right a few cents there, or it depends if you have taken your trade right there. If this was zigzag, we expect it will have 1, 2, 3, 4, 5 to the downside. So it will have 5 wave move. It will have 5 wave move. So maybe you can wait for retest around this area. You can wait for retest around this area, then take a trade down, or you can take a trade now around the invalidation level. Now, how may you project for your TP? How to project your TP? Now, your TP will be projected by taking a consideration of, usually now based on wave relationships. TP is based on wave relationships. Now, based on wave relationship, distance traveled by wave A usually is equal to distance traveled by wave C. In most cases now, it's not usually, it is in most cases. In most cases, the distance traveled by this wave A will be equal to the distance that wave C is going to travel. So you will measure extension as usual. You will measure extension. Now here you are going to take to put your take profit at extension of 1.0. At extension of 1.0 is where you can put your take profit. But sometimes wave C may be extended. Wave C sometimes may be extended, whereby it can move up to 1.23, yeah, things like that, 1.23, or sometimes it can be even 1.16 or anything else of wave A. Extension also may occur in wave C. So if it is extended, actually it moves beyond this level of equality, between this ratio of equality, the equality that's the ratio of 1. So when you are putting your take profit as usual, make sure that you don't put exactly at this point. You can put a few cents below. If it is 1.0, you can put your TP at 0.9 or 0.8. You put something right before that exact point, because sometimes those movements, they undergo failure. Those movements they undergo failure. They fail to reach exact point where it's supposed to hit. So if you put at that exact point, you may find that sometimes price may turn before touching that that particular point. Now that's all. Those are the rules that you can put on the wave principle. Those are the rules that you can put or incorporate in a wave principle in order to make it a trading strategy. But learning it and applying it directly in the market, actually it may not work profitably. In most of cases, you will be confusing yourself on where to take a trade, where to put a stop loss and other things, and also how to manage your risk and other stuff. So now, based on PSC strategy, or we call it as the arrow strategy, based on PSC or based on the arrow strategy, it's very very important to understand the structure of corrective waves if you need to trade profitably. If you need to trade profitably, you have to have great understanding of corrective structures, because we have said that pullback has got a setup for the comeback. Now, pullback, when the market is correcting, it has got a setup. This setup is for the comeback. So now, when the market is correcting, it is just preparing itself for the comeback, that is movement in that particular direction. So in order to trade profitably, you must have ability to interpret the setup. You must have ability to interpret the setup, because once the market is in a comeback, it's very difficult to capture the move, because an impulsive move is very fast. So once the market is already in a comeback, it sometimes may be very hard to capture the move. So understanding corrective waves, it is very key if you need to trade with the PSC or if you need to trade with the wave principle in general. You must have a greater understanding of the corrective waves. Now, so on the basis of this concept of understanding corrective waves, this will take us straight to the coming sessions. This will take us straight to the coming sessions, whereby the coming session will be all about the possible variations in corrective waves. We'll discuss the possible variation in corrective waves, because corrective waves, we know things like zigzag, we have things like flat, or we may have things like triangles. So things sounds like very simple. A flat, a zigzag, a flat, they sounds like very simple, but a zigzag has got its own potential variations. A flat also has got its own potential variations. So now in the coming sessions, we are going to discuss all of the potential variation in order to make everybody able to trade with the PSC. Because if you don't understand the corrective structure, you will be unable to apply PSC profitably. You will be missing most of the potential moves. Most of the potential impulsive moves, you will miss them because you don't understand the corrective structure. You will be unable to understand if they have yet completed or not. So now, checking on one of the quotes, I can call them as the quotes, but those are the contents from Elliott wave key to market behavior. So now, corrective waves are notoriously difficult to interpret. Corrective waves are notoriously difficult to interpret. So now, from this idea, it is true about it, but someone said, I don't agree. No, I don't agree. Someone said he's not agreeing with this, but yeah, it's just according to his or her own views. But mainly for those who have covered the idea of Elliott wave, I'm sure they struggle a lot in understanding corrective waves than understanding impulsive waves. Impulsive moves have got very few potential variations. They have very few potential variations. But if you come across with corrective waves, you will find that have got many potential variations. So in the coming sessions, it means the 6th session, next one, the 8th, 10th. Yes, I think it may be up to the last session. The major discussion will be about those corrective waves. We'll discuss things like wave relationships. We have those called the ratio relationship, multiple wave relationships, the issues on potential variation in zigzags, potential variation in flats and triangles. Those are the major things that we are going to discuss, and this will be important in order to make everybody able to apply the wave principle as a strategy. You will incorporate those things that we have discussed here, and also have those information in previous sessions. When you incorporate all of them, you'll be able to apply the wave principle as a strategy by putting your own rules, entry and exit rules. Also, you'll put your own money management rules. Now, that's all for today. Is enough for today is enough, and I'm sure everybody have got me, even though probably I was speaking a little lower. Sometimes maybe I was speaking a little lower, and this is because of time. It's tonight now. It's tonight, so I don't like to disturb people there. So I'm sure we have done together. So thank you for your time. Make sure you subscribe to the to our channel. Actually, I've got our channel right there, Awesome Forex. You have to subscribe it to this channel. Also, you can click those buttons there in order to follow those major links. Our major links here, we have buttons there, so you can click a specific button and then it will take you directly. It will take you directly to where you want to go. So now I'm through with this. So have a nice time and have a nice trading week. Thank you.